Hi, Chapter 4 Overview with hints to follow. We're going to talk about the balance sheet and the statement of changes in retained earnings, or also called stockholders' equity. So the balance sheet shows the financial position of the company at a certain point in time. It's also called the statement of financial position. This brings up the accounting equation: assets equal liabilities plus owner's equity. This is the starting point for your financial statements. Uh, the assets, liabilities, and owner's liability are also considered the elements of the balance sheet. They are always recorded at historic costs, which means the cost that you bought them at. That follows them throughout. What happens, or what we use a balance sheet for, is to look for the liquidity or the nearness of cash, how quickly we can sell short-term assets to be paid to pay for bills, the financial flexibility, the ability to use the resources to adapt to changes if there's a change in climate, economic climate. The other thing is we look at it to see if they can maintain their presence or if this is a viable, sustainable business. And basically, there's a lot of equations that come out of the um, elements of the balance sheet. There are some limitations to this, though, and there's quite a bit of controversy about the historic cost valuation. What do we do with markets when it goes up or even when it goes down? How do you reflect that? Many of you know you can mark something down, but you can't mark it up. Is that a fair evaluation? It's a question we have to ask. Not all assets and liabilities are listed. How about Microsoft and Bill Gates? You know, how do you put a value on Bill Gates or Steve Jobs or uh, an engineer that for Ford that created the Mustang? So, you know, that all the liabilities are not listed. So that becomes an issue. You really have to dig to really know what is valuable. And some of the amounts are based on estimates. It makes a lot of people nervous, such as we estimate the salvage value. We estimate allowance for doubtful accounts, many things that we estimate. If we miss that estimation, then our statements aren't right. It doesn't look at periods of inflation. They're not noted, or changes in purchasing power. And sometimes it's hard to compare fair value when it's used because not all companies use it the same. So, you know, balance sheet is a good overall reflection of the company. It does have limitations. Please remember that. So there are also other statements and other disclosures that need to be put forth for your financial statements. One of them is a statement of changes in stockholders' equity, and its purpose is to show the changes in stockholder equity, and by that we mean capital stock, preferred stock, anything that's in that equity area. And this is done by using a schedule or notes to the financial statement. The intent is to help report on the changes in the financial structure of the company to help users assess that flexibility that we're talking about up here. Whoops. Let's undo that. Let's make that go back. So this is a kind of a very important part of your financials, so it needs to be disclosed. And it will show investments by the owners. It will show just which would be buying more stock, distribution to the owners, which would be dividends that are paid, and it will show the changes in retained earnings with net income and comprehensive income. We're going to do a little bit of all of this, and we're also going to discuss notes and disclosures to the financial statements. GAAP has some fairly specific things that it would like to have disclosed other than just the numbers. So that is the overview. And now we're going to move on to the hints, which you're going to find in the hints from your instructor found in the assignments to be completed. Thank you. Chapter 14, Overview, Long-Term Liabilities and Receivables. This is a very long and complex chapter, so bear with it. Go with the flow with this one. I'll try to do as move as slowly as we can, but yet get through it. So here we go. Let's give this a whirl. We've got quite a few activities to do, and what we're going to look at is recording a bond. We're going to record it at a premium, a discount, and using the effective interest rate. We're going to look at recording an impairment, of which I'm going to show you step by step how to do this, recording a long-term note payable, and finally serial bonds, which are bonds that come due at specific times, not all at one time, but in a series. So as you walk through this chapter, kind of focus on these concepts as we move along. So the definition of what we're looking at right now is an obligation that will not be repaid within the current year or operating cycle, whichever is true for the company. Most common examples are going to be a bond payable, long-term note payable, lease obligations, which we're really not going to look at in this chapter, but in a future chapter. Same thing with pension obligations, deferred income tax, and other long-term deferrables. The last three, leases, pensions, and deferred income, we will look at in future chapters. So right now we're basically going to look at the long-term notes payable and the bonds payable. So why would somebody finance when you could just sell stocks? Well, a variety of reasons. First of all, debt financing may be the only available source. You may not want to dilute your capital stock out there. You may not even be a public company. You may be a private company, and that may not be an option for you. Debt financing may have a lower price than any other option. It may offer income tax advantages, and we've all heard of those. When you do a long-term liability or a bond, they don't have voting rights, so you're not diluting your ability to maintain control of your company. And finally, it might offer opportunities for leverage, such as if you have a lot of equity built up into a building, you don't want to sell that building, you may use it for collateral to leverage up to create something else within your company. So those are the reasons. Let's kind of get used to some terms, especially for bonds. A bond is literally just a loan that comes due, and you have to pay the interest on it. And it has a face value, which is its par value. It has its maturity date, which is its payoff date. It has a contract rate, which is the stated rate of interest at the time that the bond was created. The effective rate is the rate that the market is bearing at the time that it is sold, which is the rate that the bond will actually be repaid on. You have the bond certificate, which is the legal document with the face value, and you have the bond indenture, which is the contract that defines the right of the holder. So those are new terms. Kind of get used to them. There's nothing big there, but I think the two biggies are going to be the contract rate and the effective rate. So let's just keep moving along. Bonds can be issued in a couple of ways. They can be issued privately to institutions, such as to a pension fund, to even an endowment fund, to a bank, to anybody, any institution that might want to invest. The other way is through the public, and they are sent to an underwriter, and then they're offered to the public, but first they have to receive approval from the authorities. You have to set the terms, the rates, the maturity date, and then you'll make a public announcement for them. The bond will have an effective rate which matches the market at the time of the offering, and that definitely will be may be different than the stated rate, and this is called the yield rate, which probably I should have put up under terms, but remember, yield rate. Three ways that the bond can be presented. It can be the yield and the stated rate are the same, so it's sold at face value. The yield rate is higher, or the effective rate is higher than the stated rate, it's sold at a discount. The yield rate or the effective rate is lower, so it's sold at a premium. Now, I know those all probably are fairly vague to you right now, but after we get through the chapter, you're going to see the difference. You'll actually amortize a premium and a discount, and you know how to do that, so it's just a matter of wrapping around these terms. We're going to look at various bond offerings. As you're going to see, there are several kinds. Most of them are going to come at a premium or a discount. So you're going to be making good use of amortizing premiums and discounts. We will also look at extinguishing bonds, and that doesn't mean using a fire extinguisher on them. That means selling them or paying them off. You're going to look at long-term receivables and impairment of a loan, and you're going to look at serial bonds, which are bonds that come due in installments rather than at one period in time. So that's our chapter. That's what we're going to be looking at. Again, remember to look for these items because those are the ones that we're going to be doing activities on. Thank you. Okay, put on your thinking caps. This is loan impairment, and it does seem somewhat confusing. So I'm going to try to break this down. This is actually exercise E14-28. The numbers are a note for $200,000 for 5 years at a rate of 9%. The first year's installment for the interest was made, and then immediately on this date, the bank was informed they would not make the next two interest payments here or here, and that they would start making payments again on 2013, make them in 2014, and not pay the principal until 2015. So you can kind of scratch your head and you say, okay, now what? Well, I put it out in 5 steps here. Step 1, you're going to set up the numbers. You're going to set up a timeline, and you're going to find the present value of the note and the interest payments. Because that note at this point in time is not worth $200,000. You've got to bring it back to present value, and that can get a bit sticky. We'll go through the present value tables. The next thing you're going to do is really look at the timeline down here. You've got to lay it out so you can figure out what's going on. Then you're going to have to set up an allowance for doubtful accounts because you're not getting any payment here. But you are going to get some here, so you can't write the whole account off. After you do that, you'll record the interest revenue and reduce the allowance for 2011 and 12. Then in 2014 and 13 and 14, you'll take off doing regular entries again. But you've got to do it in steps. So let's look at this timeline. This is what it should look like right here, all the way across. This is our should be. And this is what the impairment looks like right here. You can see you're not getting revenue for 2011 and 2012. But you are going to get the full amount, or you're going to get the amount here, but you're going to lose this amount in this period of time. So you've got to figure out what is the present value of that. And that is step 2 in this little adventure. So you're going to have to use the present value tables, and this one is table 3. This is a lump sum. This is the principal amount. It's actually worth $129,986.20 using the factor from table 3. The next thing you have to figure out is that $18,000. Now this gets even more interesting because you're deferring 2 years. So the first number here, your first factor, is figured on 3 years. at 9%. That gives you this, but you've got to do something about the deferral here. And this is 2 years at 9%. And you'll see this is a percentage. So now you're going to multiply that out, and the lump sum, or the amount of these two payments that you're losing, is worth $38,000. So now you're going to figure out the value of the impaired loan. So if I take the principal and I take the value here of, oh, I see what I did. This is actually what the payments, the interest payment is worth at this point. I said that incorrectly. So you're going to add those two together. The value of the impaired loan at 2010, right here, with these two payments being deferred and moving it on out, is $168,335. That's the number you're going to play with. Now, my guess is here, you've got 200,000, you've got 168,000. The difference between that is going to be the amount of money you give up at present value for these two payments, interest payments. That becomes your doubtful allowance account. Now you're going to start recording things. The first payment that you miss, which is this one right here, is 9% times the present value, which is $15,150. The second payment, you've got to take this, which is the present value of that payment, and add it to the present value of the year before. That will give you the present value of the loan at this point in time. And multiply that by 9%, and that's 16,000. Now you have all of your numbers you need for the activity, or for the entries. So let's move down here and get it started. On December, when you find out the loan is not going to be paid on time, you set up a bad debts expense. This is the amount that's being deferred. You're going to credit an allowance for $331,664.07. That sets up your doubtful allowance count. Now you're coming up and you're doing interest revenue. Now we're on 2011. The loan is still good. It's just being deferred. So this is going to show a revenue of that first interest payment that's missed. This is going to be the second payment that's missed. You're still setting up as if you were receiving this as revenue. But now, what's happening? You're balancing that. If you add these two together, they come up to that bad debts expense. So these two revenues that are being recorded in the year that they occur are actually being removed because of the bad debts expense here. And you're taking down the allowance account. So now you've got a zero amount in the allowance account, and you have your bad debts taken care of, and you're still recording the revenue as required. Now along comes year 2013. We're back on track again. They're paying the $18,000, and you're putting in the interest revenue. So 2013 goes great. 2014, you have the same entry. And finally, in 2015, you're getting the money. Here's the cash, here's the interest revenue, here's the cash, and then you're writing off the note. I know it's very confusing. Just kind of look at this. If you'll look at page, I forget what page, it's on page 684. 684 and 685, they show a really good example of this, very similar to what we just done here, only they're using different numbers. So kind of take a good look at this. I'm going to put this whole answer up in the submissions, assignments for submission. You can do the problem, talk about it, ask me questions, and we can go from there. Please submit it in this form. Okay? Thank you.